Dividends. That's something that most people would have come across. If you are the shareholder of a limited company, the dividends may be something that you've encountered. You may be the recipient of them as well. Now, in today's I Hate Numbers video, I'm going to be talking about dividends, particularly what they are, how they're paid out, what the interaction is between that and the director's loan account, and I'm going to be less on the tax-efficient treatment and the treatment of dividends itself. Now, dividends are a way to extract funds from your company's bank account into your own personal account itself. They are closely and inexorably linked to something called the director's loan account. I'm going to call that DLA. It's much easier to pronounce. In this first video, part 1 of 2, I'm going to explain what dividends are, how they work, and where the DLA fits into the picture. Sounds something like out of a driving school. Firstly, let's have a look at what dividends actually are. Now, dividends are actually payments made by a company to its shareholders, usually as a reward in return for owning those shares in that company. Now, for most small businesses, the shareholder and the directors tend to be one and the same thing, and it's the directors who make that decision about what to pay out. Now, in most cases, as I've said, directors and shareholders are one of the same people, and how we actually deal with that profit extraction, which is fundamentally what dividends are, is really a key part of the director's toolkit. Now, let's have a look at some of the essentials. First of all, what are the source of dividends? Now, as a legal requirement, dividends can only be paid from profits that your company generates after it's paid all its outgoings, all its expenses, and after the corporation tax has been accounted for. If your company is making losses and it has what's called a negative balance sheet, losses are built up, then you cannot legally pay dividends. Now, it's also crucial to remember a dividend payment is not a salary and it's not an expense of the company. What that means is our friends at HMRC do not allow that to be classified as wages, so no national insurance contributions, but it also means that you cannot deduct the dividends that you paid yourself as an expense of the company, and you cannot reduce the corporation tax bill as a result. It's also important to remember you're governed by the Companies Act 2006, and it's got to be legally dealt with. It must be formally declared by the company's directors, even if you happen to be a single shareholder, single director company. Now, in my experience, most clients who do this themselves won't necessarily do the paperwork. That may not be a problem until it becomes an issue. Now, dividends are a way to reward yourself or other shareholders that you may have in the company. You've got to be able to use retained earnings or retained profits. So essentially, if you're not generating profits, you can't pay yourself a dividend. If you do so, that is, strictly speaking, naughty. You're not necessarily going to go to prison for it, but it is actually contrary to the Companies Act. Now, let me have a look at the Director's Loan Account, or DLA for short. Now, the DLA is a record of all the financial transactions between you as the individual and the company itself. Remember, the company is a separate legal entity. It's not you, it's a separate beast. Now, these transactions, if we can imagine a seesaw, typically we've got two sides of the seesaw to consider. Now, when your director's loan account is in what's called in credit, that's where the company owes you money. And that could be you either put your own funds into the business to begin with. It could be you've either owed salary from the company, which is being dealt with under PAYE, or it could be you've paid expenses out of your own pocket for which the company has to reimburse you. Now, the other side of the seesaw is when your account is overdrawn. So when you take funds out to reimburse yourself expenses, pay yourself the salary that you're entitled to, repay some of the money you've sunk into the company, and it isn't covered, and you take out more than you're entitled to, then your account will be what's called a debit balance. You're overdrawn effectively. Think about your company as your banker. When you take out more than you're entitled to, your loan account will be overdrawn. Now, normally, at the end of your financial year, if your loan account is overdrawn and you don't clear it down, you don't convert that into a dividend, you're going to pay what's called advanced corporation tax, and it can be quite eye-watering, and you don't want that. Now, imagine you've taken £5,000 from the business during the course of the year. It's not for salary, it's not for reimbursement of expenses, and it's not for money you've initially put into the company. That means your loan account is going to be £5,000 overdrawn. The normal practice is that you declare a dividend. You don't go out to the street, by the way, and say, I'm paying a dividend. There is a process that you have to go through. Pretty much it's paperwork. Director minutes, declaration, and vouchers. More of that in next week's video. And as long as there's profits to cover that £5,000, everything is hunky-dory. Now, timing is crucial. If you take money out of the company, technically speaking, before it's formally declared as a dividend, HMRC, if it ever came to that, or your company has financial problems, could view it as an attempt to avoid and mitigate tax and paying yourself in preference too. Now, to stay compliant, always think about what you're taking out. Many directors, shareholders in my opinion, by the way, take money out of the company during the course of the year, which is quite fine, and then will declare a dividend to clear the loan account down to zero. You obviously can leave the loan account overdrawn, but you will have advanced corporation tax to pay, which can be quite potentially expensive for you. You will get it back, by the way, when it's written off, but you don't necessarily want that. Now, what's the key takeaway? Dividends and the director's loan account go hand in hand. They're closely linked together. Dividends permit you to extract profits in an efficient manner, but they have to come from your earnings that you've generated, i.e. profits after taxation. The director's loan account, an essential requirement in a bookkeeping system and account system, tracks what you've taken out and what you've put in, what you're entitled to and what you've drawn down. Now, in next week's video, I'm going to be looking at the paperwork, and yes, there is some. I'm going to be looking at the documentation, and yes, there is some. It's really crucial to remember that if you run a limited company, you have protections, you have benefits of being a company, but you also have obligations not only to yourself and your team, but also to the outside world, to your creditors. So those documents, those minutes, those voucher generations are really important. But more of that admin side in next week's video. Until next week, folks, happy declaration.